All right, let's dive right into one of the most frustrating, just maddening questions for any investor. You know, the kind of thing that feels like it just completely defies logic. I'm sure you've been there, right? A company you own reports fantastic earnings. Maybe they've launched a breakthrough product, everything looks great. And then the stock price just plummets. You're left staring at the screen thinking, what just happened? It makes absolutely no sense.
But here's the thing. What if that chaos isn't the exception? What if it's actually the market's default setting? Well, in this explainer, we're going to pull back the curtain and show you exactly why things often seem so irrational. And stick around because we'll also lay out a super clear strategy to navigate through it all.
Okay, so to really get to the bottom of this, we've got to start by throwing out a huge assumption we all make. And that's the idea that for every single stock move, up or down, there's some neat, logical reason just waiting to be discovered. See, here's what happens. We, as investors, demand to know, why is my stock moving? And the financial media, well, they feel this immense pressure to give us an answer. So what do? They take the path of least resistance. They just grab the biggest, most obvious headline in the day and say, there, that's the reason. And this creates this really powerful illusion of cause and effect. But let's be clear, it's not a real explanation. It's just a story, a narrative they create after the fact to make all the random chaos feel a little more orderly. Okay, so you might be thinking, fine, the media is just telling stories. But what about the real experts? The professional analysts, right? The ones with the fancy degrees and the super complex spreadsheets? Surely they know what's going on. Well, yeah, about that, not so much. And when you look at the hard data, it's pretty revealing. If you actually track the predictions from these analysts, their success rate consistently hovers right around 50%. 50. I mean, that's literally no better than flipping a coin. And this points to a really common bias you see all the time. Analysts, they tend to lower their price targets after a stock is already tanked, and they only raise them once it's already on its way back up. See, they aren't predicting the momentum, they're just chasing it. And really, the truth is, you can take any piece of news and spin it into whatever story you want. Take a new car from Tesla, for example. The bulls, they'll scream, it's a game changer. The bears, they'll say it's a cash-draining disaster. It's the exact same fact, just spun into two completely different stories. All right, so if the news is just noise and the so-called experts are basically just guessing, what is really causing these wild price swings day to day? Well, to answer that, we've got to look under the hood at the actual mechanics of the stock market. So think about it. When a company first goes public, the vast majority of its shares get bought up by these huge, long-term holders. We're talking about pension funds, hedge funds, and of course the company insiders themselves. And they create this massive, stable base of ownership that honestly doesn't really move much day to day. And this right here, this is the big secret of the market. The daily stock price that you see on your screen, it's being set by a tiny, tiny fraction of the company's total shares. We're often talking less than 1% being traded on any given day. This means that a really small amount of buying or selling can have a massive, totally outsized impact on the stock's price. And that explains why that tiny fraction of shares moves so erratically. Think about it. People usually buy a stock for one simple reason. They think it's going to go up and make them money. But they sell for 1,000 different reasons, and most of them have absolutely nothing to do with the company's fundamentals. Maybe they need cash for a car or to pay for college, or maybe they just got spooked by some random blog post. It's personal, it's random, and it's completely unpredictable.
And this isn't just a problem for us regular investors. I mean, just imagine for a second you're the CEO of the company. You wake up, grab your phone, and see your stock is down 10%. What's your first move? You probably call your CFO to ask what the heck is going on. And the CFO, what are they doing? They're firing up Bloomberg to check the news, just like everyone else. It's this one big, hilarious circle of confusion.
Okay, so we've pretty much established that the short-term market is, for all intents and purposes, just unknowable chaos. So does that mean we should all just throw in the towel and give up? No way, absolutely not. It just means we need a strategy that doesn't even try to predict the unpredictable. The answer, the real solution, is to completely change your focus. You have to learn to ignore all that daily noise and instead concentrate on the big, predictable, long-term trends. The things that actually drive growth over years, not hours. And this really boils down to a pretty simple three-step framework. Step 1, find sectors that are set for really high growth over the next 5 to 10 years. Step 2,
Inside those sectors, pick the clear leader, the company with the best margins and the biggest market share. And then step 3, and this is by far the hardest part, you just wait. You relax and you let your original thesis play out, completely ignoring all the market news.
All right, and that brings us to what is easily the most important and, let's be honest, the most difficult part of this whole strategy.
See, every single time you react to a news story, every time you hit that buy or sell button because of some daily price swing, you're just creating another opportunity to make a mistake. You're giving yourself a chance to get scared, to sell at the bottom, and to completely derail your carefully thought-out long-term plan.
Because ultimately, successful investing really just comes down to patience. It's about letting the actual business fundamentals drive your returns, not some fleeting market sentiment. So remember this, in investing, hyperactivity is a bug, not a feature. The less you fuss, the less you react, the better your results are probably going to be.
So that's the crucial question I want to leave you with. The very next time you see one of your stocks plummet after some great news and you feel that panic starting to rise in your chest, just stop and ask yourself, is my portfolio built to react to all this noise, or is it built to grow right through it?